Let me tell you, if they don't react by then, what my analysis, and nobody's done this in all the history that I've seen of first crashes, we'll already be down 50% on the NASDAQ and 40% on the S&P 500 and in a clear recession. And that's going to be hard to turn around because consumers, think how much they've been whipsawed with all this stimulus and tightening and back and forth and COVID and everything. Yes, we'll get a rebound then, but the stock market's already down 50%. You're not going to go to new highs after that. I'll promise you that. We go down 50% on the NASDAQ by the summer, you're not going to bounce back to new highs for a long time, if not a very long time. That's enough for consumers to see something's really wrong. And then they think to themselves, why did we ever not question we've been growing just by printing money out of thin air? That's how we've been growing. Running deficits, printing money. Nobody else is giving you this number. I'm giving you $27 trillion, now going towards 30. Just since 2008, we went down. This has never happened. This is easy way out, something for nothing. Worst economic policy in history, and I think they're going to pay for it now. And I hate to be the messenger, but hey, I can do it because I was the most bullish guy in history. And find one more in the early to mid 80s when I said we're going to have this baby boom, greatest boom in history, Dow 10,000 by 2000. People were falling off their seats saying that's impossible. I'm saying don't underestimate how stretched this economy is, how big this bubble is, how much it could crash in the next few years, and even by summer. I think you're right. If they do react in summer, it's already going to be too late. They're already going to be behind the curve. And how do you get over a 50%, 4 to 5 month crash in stocks? How do you come back and say, oh, well, that's no problem. Well, everything will be fine. No, that's enough to wake up consumers to, oh my God, why did we believe in money printing in the first place? Well, 2007 was the peak of the baby boom. I would have been surprised if I had said that. I'm saying after 2007, there wasn't much to drive our economy to new highs, except I do have a 45-year technology cycle that actually peaked in 2019. So one way or the other, I mean, look at that crash. How long did it take to recover? I'm saying we are exactly where you're pointing, just seeing the peak, going into only the first crash, which will continue for another couple years and take us down 80, 90% or more. That is not something to sit through regardless of what happens after that for the next year. But we don't have the demographic strength. The millennials only bring us back to where the baby boomers were in 2037 when they're at the best of their cycle. They don't even bring us to new heights because they're not as big a wave of people, and waves of people are what drive our economy. I'm telling you, this has been a total BS rally since 2008. 100%. No time in history has this ever even close to 100% from stimulus, not from demographics, not from natural fundamental strength in a rising tide. And there's always a bigger rising tide in the future. And now this bubble is bursting. And if you want to hope that this was it and we're going to go to new highs, well, okay, hang in the market. Or if you got out, get back in. I'm saying everything's thus far, until I see otherwise, is following exactly what you'd expect in the first crash. And we're only halfway through this first crash, and there'll be 2 more to follow that. That's the truth. If you look back at major declines like 2000, 2002, and 1929 to 32, and 1972 to 75. Those are major generational type crashes. And to me, buy and hold for the long term, rebalance, yes, but not when crashes of this magnitude where you don't usually see new highs. For I think last time between 68 highs and getting to new highs, it took 23 years. That's not a time. That's a time to get defensive I'm just saying for the next couple years. And if you don't want to do it, take your chances. I'm just warning you, this looks like everything I expect. And I'm the guy, along with Jeremy Grantham and a few others, warning of something of major magnitude, not just another difficult correction here. I've studied bubbles. You find somebody studied bubbles more than me, then bring them on and let them tell me I'm wrong. If you really want to play a downturn, the best thing to do, and you can do this mildly or heavily, the stocks react first, okay, to a deflationary downturn like I'm talking about. And that's different from inflationary crashes in the 70s and other major corrections and stuff. 40 to 50% is typical in the first 2 to 4 months, that first crash. And that's what I think we're likely in, okay? Once that happens, it's the treasury bonds that do the best in the end. In 2008, it was TLT that rallied 40% in the second half of 2008 when stocks were just finishing their last wave down. So I tell people to be in treasury bonds instead of cash because they will tend to go up modestly at first in a downturn, but when it really gets bad as I'm thinking, they do better and nothing else went up there. Even gold went down. So that's the place to be, but don't expect big returns at first. Just expect it to do better than cash. And if not, just be in cash. But the point of the thing, you don't want to get killed by the first stock crash of 50%, nor a total crash is going to be more in the 80-90% range, because that's not something you recover from. And even if you were smart and held fully, people don't hold, and then they get out somewhere in that crash and they don't get back in till long in the rebound, and so they don't come out well even if they play it half smart. So the best thing to do here is be safe. Bring on somebody to show me a bubble that's bigger than this, and I'll say, oh, I must have missed that. Okay, bubbles only crash drastically. They don't have soft landings, period. People like me, like Peter Schiff, who see the same bubble crash and all this stuff of money printing, living forever, deficits, he thinks gold's going to be the saving this thing. I say, no, look at 2008. Gold went up into the early part of the recession and then went down about 40% at the worst in 2008. So it wasn't a bad place to be, okay? It was the treasury bonds that were the ultimate safe haven. I think gold is closer to peaking here. I think if you like some gold, it's a good diversifier. It won't go down as much. I'd say 1,100 to 1,400 is the downside on that, which is a lot less than stocks. That's only down 40, 50, 60%. But I don't want to be in something. This, yes, if I looked at this chart and I didn't know what it was, I'd say this looks like the fifth wave peak too. And this is an everything bubble, as people have been smartly calling it. And even the roaring 20s wasn't an everything bubble. Real estate didn't bubble that much. Gold didn't, and commodities. So yes, I would not be buying gold here. Gold will be an excellent buy after the crash because the biggest beneficiary of the entire commodity sector in the next great boom in the coming decades will be when India becomes the next China. Indians, consumers, spend 3 times of their income compared to Chinese consumers in gold. And India is going to be the next China for the next 40 years when we come out of this crash. And China is never going to see new highs in anything ever again in our lifetimes because it is a shrinking country following Japan and South Korea and the rest of East Asia. China was the worst real estate bubble in history. 22% empty homes coming in. Imagine how many empty coming out through a real estate crash. And if you think our real estate crash down 40, 50, 60% could be bad, think about China's down 70 to 80 in real estate, and people having 1 or 2 extra empty homes, everyday people in China that aren't even a fifth as rich as us. China's going to be the biggest disaster story in history. It's another reason Donald Trump can't prevent this downturn. China falls, the rest of the world goes down. It's the second largest country and responsible for most of the growth in the last 4 decades. 40 years from 50 years from now, India will be 1.7 billion and China will be 800 million, down 40% at the rate it's going, and just following Japan. Japan's already shown that a country can shrink because of affluence. Affluent people don't have kids because they want to have 1 or 2 and get them into Harvard or Stanford, okay? That's what kills a country, affluence. I'm a cycle guy at heart. Every cycle goes up and goes down. There's always the very thing that brings it up eventually brings it down. Affluence brings down births, and that's the Achilles heel of the developed world today. Everybody's peaking. The Scandinavia's just last, okay? And Japan's just first. And China, here's the big insight though. China's the only emerging country that has demographics like the rest of East Asia that collapse in the future instead of continuing to go up, even though more mileage. China is unique in that. And everybody thinks China's going to take over the world and be our biggest competitor. Nobody's going to be worrying about China 20, 30 years from now after this. They will get hit twice as much harder than we will by this crash. And their top-down government has bastardized free market economics more than anybody on earth, building homes for nobody. You can only grow through immigration and higher productivity. And the United States is still one of the most productive, even we are maturing. My demographics has said from the peak of the baby boom, which naturally was 2007, into the peak part of a longer plateau in millennial spending, those two are at the same level. We're a plateauing country from 2007 to 2037, which now is not that far away. And then we just decline slowly into the sunset unless we up immigration. And we're outside of Australia, we're one of the strongest immigration countries in the world. But we have anti-immigration sentiment, including Donald Trump. Another thing that will happen at some point, we are going to see people live to 100 and then maybe 120 broadly over several decades in the future. That's the only thing that could bring the developed world back into a demographic growth position where people are in the workforce much longer, earn, spend much longer, and stretch their spending. Could that save the developed world? Otherwise, we are in a plateau and we're declining, particularly after 2037. This is the last hurrah for America unless we get higher immigration or start living longer a lot faster. And that living longer a lot faster is going to take longer, I think. In a deflationary downturn like this, the deflation only comes after bubbles where almost everything go up, okay? I mean, if I had to be in real estate, I'd be in multifamily apartment buildings. They will hold up the best. But if real estate's crashing, they're still going to lose some value, but that wouldn't be a bad place. But I'd still rather be in the treasury bonds because they would actually appreciate if I'm right, okay? So the options narrow. The best thing is the highest quality bonds. And why fool around with AAA corporates when you can buy a 30-year, longer duration than 20 corporates? The longer duration and the higher quality is what does best. You can buy 30-year treasuries, or you can buy a simple ETF like TLT, which is half 10-year treasuries, half 30. So let's say a 20-year treasury on average, and actually see appreciation in a downturn, and then have more money to reinvest rather than just protecting your money when the next great boom comes along, which will be focused much more in Asia. This is one of the biggest misconceptions, that Bitcoin and crypto are the safe haven. Absolutely not. They are the biggest bubble. They are a new emerging sector. I didn't get it at first, except I could see that Bitcoin was acting just like Amazon, the leader of the .com retailers, which was the first tech bubble. I said it was acting just the same. So I said, no, this is the next bubble. This is a big thing. Now I get it. A guy at my own conference 3 years ago says crypto and Bitcoin is basically the restructuring of the entire financial services industry. And I got the number, the total of all financial assets in the world is 6 times global GDP. It's 630 trillion. So crypto's here really to restructure and make everything more efficient about investment and trading and everything. It is the next big thing, along with AI. And I've been talking about AI. I used to call it the automation of professional and managerial work. We've already done that to clerical people, already done that to factory workers, already done that to farmers if you go back. It is the professional classes that will be automated by AI. So AI and Bitcoin. So I say if 2 things I want to buy coming out of this, I buy Bitcoin at the bottom and NVIDIA, leader of the AI, and Bitcoin, leader of crypto.